Hi there, Lance Jepson with GorillaStockTrading.com, and I just want to do a quick video here that shows you the way that I like to use the slow stochastics and how I decide on what my settings are going to be. I always get a laugh out of traders who try to do one size fits all, like 5-5-5 or 14 12 and 2 or whatever, right? I don't like to do that because you know what? Every market, every stock has its own personality, and the personality changes depending upon the time of year. So you can't just do one size fits all. And look, with the modern day computers and how powerful they are, and trading platforms that have interactive Java like Market Club, why would you be fixed to one? Simply do this. Let's go ahead, and as you can see, the settings here, I'm going to turn off the fast stochastics. I don't even want to use that. And what I like to do is I would like to be able to trade these ranges back and forth. So what I'll do is I will adjust this, and as you can see in real time, the %K line changes, and the moving average, or the %D as a calculation of the %K changes also. And you can change all of them. So this allows you to really set your signals depending upon your trading style, whether you're long-term or swing trader, to better time and fit the signals to your trading style. So what I want to do is I want to do one where I like to use the red signal line when it falls underneath the 20 line. There we go, that looks about good. And let's go ahead, no, that's two. There we go. I want a bit more sensitive moves. I want to sell when it breaks above the 80 line. There we go. And it looks like pretty much the best that I'm going to get is about right here. So in this case, it's 8, 3, and 1 are my slow stochastic settings for my trading style on SPY. And as you can see, this got a little rockety. We could probably smooth that out if we wanted to with some signals, but in any event, here's where I would be buying when it broke underneath the 20 line, and here's where I would be selling when it broke above the 80 line. Now, another thing that I like to do is not when it breaks underneath, but when it breaks over it. So, for example, this was not a buy until the red line crossed above the 20 line. So this would have been a buy right here. Okay, and then it's a sell as it gets up close to the 80 line or breaks over the 80 line and then comes back down. So, for example, this is a good one. Here, when it broke above the 20 line, this was a buy right here, and it was a sell when it broke underneath the 80 line. Here, it was a buy right here, and here, it was a sell right here. Now, what you can do too is you can use the %D line, and when the red line or the %K line crosses the %D line, then you'd sell. And when it breaks above it, then you'd buy. So in that case, if you're using the lines crossing as your signals, you would have bought here and you would have sold here. That was excellent timing, right? You would have stayed out of all of the market. Here you would have gotten a head fake. So again, you could smooth this out and make it even less sensitive to work out a lot of these head fakes. But here you would have had to watch out for. And you could see that in this case, it would have been better to wait until the red line, using the system of the red line breaking above the 20 line. Right here, when it broke above and went 22, you write it up. And then as the red signal line breaks the blue line, that's when you'd sell. And so you know, you can study this and pick out which system that is working best for this market, and that way you create a unique and custom slow stochastic indicators and signal system for whatever stock or market you're trading. I find that that works much better than just using 555 or whatever.